Hi, welcome to my channel. So remember in previous video I showed you how you can calculate your CFI, which is cash flow index, in order to define which credit card that or any loan that you can pay off first, because you have to prioritize and get rid of the loans or the credit cards that you pay a higher monthly interest in order to increase a little bit of your cash flow. And I know around this time many people are struggling, so I thought, let me give out something pardon me, that might help some people. And make sure to hit the subscribe button, and just click that bell button for notification for future videos if you find very interesting, that this is going to help you. So in today's video I'm going to show you on how you can actually apply in reality. So I'm going to make up some scenario which you can then you can follow easily, okay, if you didn't follow the last video. All right, okay, let's crack on. So I have assumed a person who have an income of £3,000 per month, okay, but that person, they have some debt, okay, they have a credit card, a MasterCard here, which is the balance is about £4,000 they have to pay off, and they got another Visa of £500, and they have to pay off MasterCard another 500. So this person have about 3 credit cards. Okay, I'm just taking an average person here in the UK. Some people have more, some people have less. So, but this video is really going to show you how you can get rid of this debt. Okay. Sometimes I know I am not against debt. If it's a good debt, it's good. But if it's a bad debt, where if you buy, you get credit card or this debt to acquire liability, then this is a bad debt. Okay, so let me show you how you can get rid of it. These are the limits. You got the limits. Every credit card will have a limit. You can't spend more, right? Okay, so let's assume that now this. Let me grab my pen. Let's assume this person, the first credit card, let's calculate the CFI for the first credit card. So let's just assume that this person, they are paying about 100, let's say they're paying about 40 pounds. This person is lucky, they managed to get good interest rate. Now the good thing about the credit cards, they use an interest calculation method, which is a simple interest. So it's calculated on a daily basis. Okay, so when you have other loans like car loans, etc., they use what you call amortized interest. So it's calculated. That's why they give you the loan. They say, look, it's going to be 5 years, and this is going to be your monthly payment, and it's not going to change. I mean, the reason why they do that, you're going to end up paying a lot of interest, but it's fixed. So people take it because they know they can afford it. But however, if that person loses a job, then it's a problem as well. So personally, I like simple interest, because if you get cash from somewhere, you can pay it off. And the good thing about this type of interest, simple interest, means if you pay a balance, you have that money available to you again to spend. And that's the whole point of this video. So you can increase your cash flow. You can reuse it over and over again. Okay, many people think credit card is kind of like a devil's, like a taboo, but if you know how to use it properly, it is actually a great tool to have. Okay, right. So let's say this person, for example, they have they're paying £40, £40 per month for this balance. So let's calculate the first scenario. So the first person, they have, okay, so the CFI, which is cash flow index. Okay, so CFI for this person on the first credit card, so they're paying, so the balance we see the formula is the balance divided by the minimum payment. So we don't know the minimum payment for now, but we're going to assume that this person is paying a minimum payment of £40 per month. Okay, so the cash flow index number in this scenario is going to be 100. Okay, it's going to be 100, right? So this is not pounds, so we can get rid of it. Don't need to. You take the you want to get the cash flow index number. So this is going to be let me just show you. So 100. So in the first scenario, the person, they managed to get a deal where they pay only £40 per month, all right? On the second credit card, if we look, second credit card, the CFI number, so we're going to assume that, so this person have a balance of £500, but let's say on that £500, if this is one of these high lenders, high street lenders, I mean, these companies which charge you a lot for using their credit card. So for example, this person now, they have the 500, and then now they're paying about, let's say they're paying, let's say they're paying £50, okay, per month on this one. So their cash flow index number is now 10, right? Cash flow index is 10. All right. So let's have a look at the third scenario. Now this credit card, their CFI number, cash flow index number is 500, but in this scenario, the person is paying a minimum payment of, for example, let's just say the 20, let's just say £25. Okay, you pay £25. So now the CFI number is 20. All right. So now the way these CFI number, as I explained last time, let me just draw a little bit of like a timeline, but this is not a timeline. Let's call it a debt line. Okay. So you've got we've got a danger zone. So we've got danger, like I show you. Okay, and you've got a kind of like a medium area, and you've got like a freedom freedom zone here. Okay, freedom zone. Now anything here, it is this is anything which is 0, which have an index number between 0 and 50. This is what we call a danger zone. So if you do this calculation here, and then you see the number you are getting is between 0 and 50, it is a danger zone. This is the first debt, kind of debt you need to get rid of as soon as possible, because what happened is the whole point of this exercise so that you can have more cash flow to spend if you need to do it, or you might use it for something else. Okay, now let's have a look. So it looks like the credit card 2 and 3, they fall under here. All right, and the credit card, and the middle bit is anything between 51 to 99. Okay, anything that got between 51 and 99, that's the middle bit. This is the way you can restructure. For example, what you can do with this type of credit card or loan, you can restructure. You can go back to the lender and you can ask them to give you, I don't know, a lower interest, or kind of restructuring to make it a bit better, maybe to fall into the freedom category. Now, but we can see that the first credit card, he got a balance of 4,000 and only pay £40. He got 100 as a cash flow index number. So this, the first credit card, it falls under the freedom. Really, you don't really need to pay off this one because it's really small interest, and you know what's the point of paying it off really quickly unless you have cleared all the debt and then you want to do something else. Okay, but this video is all about showing you, if you've been struggling with managing your debt, managing your credit card, and you don't know which one you should start to pay off first, you don't know how to do it, this strategy what I just showed you here, we're using the cash flow index formula. It can help you define which one you can start to clear off first as a matter of urgency. Okay, this is how you can clear your debt very quickly by tackling first the biggest interest payment per month, and the one that have the smallest cash flow index, it tend to be the one you're paying a higher monthly fee for your loan. Okay, so I hope this has helped you. So now if you've been struggling to know how to manage your finances, to know how to manage your debt, or to try to clear down your debt, I hope that this video now have given you an idea what you can start to do, and so that you can start to clear and be in better financial situation, because it's always better before you started to even think of investing or do any other thing. It's better to try to manage your finance rather than going into a lot of debt. Okay, so this is my personal experience. This is what I have. This is what I have done myself. It is not a financial advice. I'm not a financial advisor at all. I just thought I will share this because I have applied this type of strategies to be debt free. And trust me, I had a lot of debt and I was a little bit confused on how to do it. And I had a friend of mine, a mentor, who has showed me how to clear off this one. And now I wanted to share with you because I know this time is a very difficult time for many people. And by the way, if you like my video, don't forget to subscribe and make sure you hit that bell button for notification. And then in future video, I'll be sharing with you a lot more. I'm going to start with helping you manage your debt, helping you, and then I'm gonna show you in future how you can also make more money once you started to be debt free, and how you can make more money on passive income. So what this scenario will do, the more you pay off your debt, it will give you free cash flow to spend on investing in yourself or investing in other asset that can produce passive income as well. So in some other video, I will explain the difference between simple interest and amortized interest, because it's very important. Because when you go to ask for a loan or something like that, it's very important to know what is simple interest, whether the loan you're getting is a simple interest or amortized interest. Because amortized interest, even though it might look a small percentage overall, over time you will pay more. When it's a simple interest, they calculate it look like it's a bigger percentage because it's calculated on a daily basis. Okay, but it is better overall. It is better to have. I prefer to have a simple interest loans. Okay, and especially with the credit cards, it's great because if you know how to use them properly. All right, if you know how to use them properly, and because once you pay, if you have a car loan, for example, let me give you two scenarios just to give you a bit of hint. So you have a car loan, for example, which you're paying, I don't know, £300 every single month, and you're going to pay that for over 5 years, for example. And then you have a credit card, which and that card you're paying, I don't know, they say for APR, annual percentage rate per year, 6%. It seems very attractive, but overall you pay a lot more interest on that loan. However, if you had a credit card, for example, and then, for example, say that card was 12 grand, and then you take the credit card, you pay that card off 10 grand, and then and every single month you take your salary. I'm going to show you in the future video. You can take your salary, because you take your salary and you pay into your credit card. I will show you how you can even create more cash flow, because what it is credit card is charged on a balance. Okay, so if you reduce the balance, that interest is only calculated on a balance. The amortized interest for the loan is already calculated. You have to pay the same amount no matter what. Doesn't matter when you pay a bit more this month, next month you have to pay the same amount. However, on a credit card, for example, if your balance was £12,000, and say, for example, you paid, I don't know, £300 this month, and the next month you pay £1,000, the month after you pay a very, very small than £300, which was that minimum payment. You understand? So I will show you in future videos on how to do this. I hope you enjoyed this video. Hit the like button and click the bell for notification. Okay, speak to you soon.